Imagine you're flipping a coin and it lands on heads 20 times in a row. What are the statistical odds that the 21st toss will also be heads? Your logical brain already knows the answer. It's exactly 50-50. The coin has no memory, no motive, and zero awareness of what just happened. But take that exact same scenario and place it on a live trading floor, and things change. We can easily grasp probability in a vacuum, but put real money on the line under high pressure, and perfectly rational people will throw basic math right out the window. To see just how quickly logic breaks down, a researcher named Ralph Vince set up an experiment. He gathered 40 highly educated people, many with doctorates but zero trading experience, and gave them a simulated market to play in. This diagram maps the parameters: $1,000, a 60% win rate, a 1-to-1 payoff, and 100 trades. This mathematically guarantees a profit. Yet 95% of participants lost money. Out of 40 people, only 2 finished ahead. The rest drained their accounts. So how does a group of intelligent people, playing a game designed to hand them a guaranteed win, manage to bankrupt themselves? They fell into a well-documented psychological trap known as the gambler's fallacy. During the simulation, the participants naturally encountered losing streaks. But instead of sticking to a consistent strategy, they reacted to those losses by increasing the size of their next bets. They convinced themselves that because they had just lost several times in a row, a winning trade was mathematically due to happen. Driven by fear and greed, they started trading emotionally. But the simulation didn't care about their feelings. The win probability remained strictly locked at 60% on every single trade, regardless of what happened 5 minutes prior. When you treat independent events as if they have a shared memory, you abandon probability entirely. You take a winning system and use it to sabotage your own odds. This exact same fallacy shows up in real markets, especially during idiosyncratic volatility shocks, those moments when a stock price suddenly starts swinging wildly. Investors misread the chaos. They often fall victim to the disposition effect, holding on to losing stocks for way too long hoping for a turnaround, while rushing to sell their winning stocks far too early. Or they buy into the reversal illusion. They watch a stock plummet for 8 straight days and decide it simply has to bounce. Traders call this catching a falling knife, and it is deeply dangerous. It warps positive data too. If a company beats earnings 5 quarters in a row, investors will systematically underprice the stock. They subconsciously expect the winning streak to end, assuming the next quarter will inevitably disappoint. Financial markets do not have a magical balancing mechanism. A collapsing stock can keep collapsing, and a strong bull run can continue far longer than human intuition tells us it should. This ties into a statistical concept called mean reversion. Many traders misapply it, assuming that after a strong move in one direction, prices are automatically required to snap back and balance out. But over long periods, markets are not a series of random 50-50 coin tosses. Historically, the stock market shows a steady upward trajectory. That trend is driven by tangible factors: corporate earnings, rising productivity, inflation, and human progress. Betting against that structural progress just because you feel a crash is statistically due is a losing strategy. It relies on an illusion that the market remembers where it used to be. The market is entirely indifferent to what you believe is due to happen. We can't turn off our emotional reactions to financial pressure. We are wired to feel fear and greed, but we can choose whether or not we act on those impulses. That is why you need an objective system, like the ITM strategy, to filter out the noise. The central tenet of the ITM approach is simple. You wait for concrete mathematical evidence of a reversal, rather than placing trades based on a gut feeling that one is owed. To survive the market and avoid the fate of the participants in Vince's experiment, you have to let go of the gambler's fallacy. Stop trying to predict what's due